There's no logic behind it. Nothing fundamentally happened to GameStop, the company. Their underlying fundamentals did not change, but this was just purely speculative activity where everyone showed up to the party. And so then the party took on a lot of energy. My name is Ed Nelling. I'm a professor of finance and department head in the finance department in the LeBow College of Business at Drexel University. So the issue with GameStop was kind of a perfect storm. And in fact, even the company GameStop, you could say, embodied, in this case, the gamification of stock trading. So what happened was one or more investors bought shares in GameStop, and then the message boards, in this case on Reddit, started to light up with all of these comments about buying GameStop, it's going higher. There are plenty of other cases where you could buy a stock and start posting on message boards and no one would pay attention. For whatever reason, in this case, everyone started to pay attention. And what happens is the price rises and then that brings more people in and they say, oh, GameStop doubled yesterday. Let me buy in, let me jump into the pool. And you get more and more and more fuel on the fire, and that leads to this incredible price surge. Now this happens from time to time, but what compounded the effect in this particular case was that there had been some significant short selling in GameStop stock, particularly by large investors known as hedge funds. What does it mean to sell short? Well, everyone knows the old saying, buy low and then sell high. Short selling flips that around, where first you sell high and then you buy low. So a short seller will borrow shares from another stockholder and sell them into the marketplace. They are doing that because they expect the stock to fall in value. If you sell a stock at $50 a share and the price drops to $40, you go back in and buy it at $40 and you've made $10 a share. In the case of GameStop, we also had what we would refer to as a short squeeze. When investors sell a stock short, eventually they have to buy those shares back. The short squeeze is a result of the mounting losses incurred by the short sellers, and then they move into the marketplace. That creates additional demand for the stock, pushing the price up even higher. Part of the speculative activity in GameStop and in other stocks recently has been fueled by the trading on the Robinhood trading platform. It's an app you can trade from your phone. It's very easy. And that is the potential danger. Are we investing because we like a company, we think it's going to grow in the long term? Or am I just placing a bet that I'm buying something today for $10 and I'm hoping it's going to go to 11 as quickly as possible? And what's happening now actually happened a little over 20 years ago with the advent of the internet and what we call day trading. So everybody started to get information on the internet and they could do these online trades. And the worst thing that happened is people placed very large bets and they couldn't recover from that. So they gambled away their savings that they needed to pay their rent or pay a mortgage or make a car payment or pay college tuition. And then that put them in a very bad place financially. All of this speculative activity that's occurred recently, GameStop, AMC, the latest stock is Inovio, and there will be others in the future. One good thing about it is that it has increased awareness about the stock market. If investors learn more about investing, if they think and understand the difference between investing and speculation, and use the knowledge to their advantage. For those that are considering starting out investing, I would offer 3 tips of advice here. One is start small. By that I mean start with an amount of money. You don't expect to lose it all, but start with some money that you could afford to lose. So you don't want to gamble your mortgage payment or rent payment or tuition payment on your next investment. But start with a small, manageable amount of money, a manageable amount of capital, and then look for stocks that you know. You know Amazon, you know Starbucks, you might know other companies. You might research some company that you never heard of and learn about something new, but pick something that you feel like you know something about the company or the industry or the products, and then do some homework. Read news articles. Read on websites that talk about how to analyze financial statements, because that knowledge will serve you well. Even if you don't make a lot of money on the investment, you're still going to gain because you become a smarter investor. And so what you want to do starting out is to acquire that knowledge, that investing intelligence that will serve you well over your whole life. So start small, start with something you know, and then if you're going to scale up your investments, you want to diversify. That's the old adage, don't put all your eggs in one basket. There are many ways to do that. A very easy way is to do it through mutual funds. So what an investor could do is put most of their money in mutual funds and then say, I have 95% of my money in mutual funds. The 5%, I can go ahead and invest in individual stocks. I don't have to worry about not being diversified because the mutual funds have taken care of that for me. So if you put most of it in a diversified fund, you can go ahead and buy one or two or more stocks and you'll still have a diversified portfolio.